This presentation is merely a brief overview of the topics covered in the chapter and should not be considered a substitute for reading the chapter. This chapter covers types of taxes, U.S. federal income taxes, record-keeping preparation and filing, and taxes and financial planning. In the United States, federal, state, and local governments may tax income, which becomes complicated for those earning income in more than one state or living in one state and working in another. Governments tax income because it is a way to tax broadly based on the ability to pay. Income tax is usually a progressive tax. The higher the income or the more to be taxed, the greater the tax rate. The percentage of income that is paid in tax increases as income rises. In Illinois, the state income tax rate is flat and was increased from a rate of 3% to 5% in 2011. Sales taxes are common in the United States and are a tax on consumption of goods. Value-added taxes are consumption taxes and are popular in many parts of the world, but not in the United States. Excise taxes are a special tax on certain goods, such as tobacco and alcohol. The federal government does not derive a large percentage of their revenue from excise taxes, but excise taxes are responsible for 10% or more of the total revenue in some states. Property taxes raise a lot of revenue, much of which is used to fund schools. The estate tax, sometimes called the death tax by those who oppose it, is imposed on the very wealthiest when they die and leave a large amount of assets. The U.S. government relies most on an income tax. The income tax is the most relevant for personal financial planning, as everyone has some sort of income over a lifetime. Most states model their tax systems on the federal model or base their tax rates on federally defined income. All taxable entities have to file a declaration of incomes and to pay any tax obligations annually. Not everyone who files a return actually pays taxes, however. Individuals with low incomes and tax-exempt nonprofit corporations typically do not. All potential taxpayers nevertheless must declare income and show their obligations to the government. Individual taxpayers use Form 1040, or if they have very simple taxes, Form 1040-EZ. There are four taxable entities in the federal system: the individual or family unit, the corporation, the nonprofit corporation, and the trust. Personal financial planning focuses on your decisions as an individual or family unit, but other tax entities can affect individual income. Corporate profit may be distributed to individuals as a dividend, for example, which then becomes individuals' taxable income on an individual's income taxes, although confusingly, likely not at the individual income tax rate, but instead at the dividend tax rate. Likewise, funds established for a specific purpose may distribute money to an individual that is taxable as individual income. A trust, for example, is a legal arrangement whereby control over property is transferred to a person or organization, the trustee, for the benefit of someone else, the beneficiary. If you were a beneficiary and received a distribution, that money would be taxable as individual income. Individual income taxes may be filed as single by a person who never married, is widowed, or divorced. Married people have the opportunity to file as married, in which case the two married individuals file as one taxable unit, combining all taxable activities and incomes, deductions, exemptions, and credits. Married people can also file separately as two separate individuals, individually declaring and defining incomes, deductions, exemptions, and credits. Head of household status is for a family of one adult with dependents. For individuals, the first step in the process is to calculate total income. Income may come from many sources, and each income must be calculated and declared. Your total income is then adjusted for items that the government feels should not be taxed. The result of deducting adjustments from your total income is a calculation of your adjusted gross income. Your adjusted gross income is further adjusted by amounts that may be deducted or exempted from your taxable income and by amounts already credited to your tax obligations. The individual filer must collect and report the information on tax forms and schedules. Fortunately, this is not as difficult as the volume of data would suggest. Employers are required to send Form W-2 to each employee, detailing the total wages earned and taxes and contributions withheld. If you have earned other kinds of income, your clients, customers, retirement fund, or other source of income may have to file a Form 1099 to report that income to you and to the IRS. Interest and dividend income is also reported by the bank or brokerage firm on Form 1099. The W-2 and Form 1099 are reported to both you and the IRS. The system for filing tax information has purposeful redundancies. Where possible, information is collected independently from at least two sources so that it can be verified. For example, your wage data is collected both from you and from your employer. Your interest and dividend incomes are reported both by you and the bank or brokerage that paid them, and so on. Those redundancies allow for a system of cross-references so that the IRS can check the validity of the data it receives. You may choose to prepare the return yourself using a tax preparation software application. There are many available and several that are compatible with personal financial software applications, enabling you to download or transfer data from your financial software directly into the tax software. TurboTax is a popular tax preparation software program that has options that range from free to nearly $100. At the stages of your life when income is increasing, so are your deductions and exemptions, which tend to decrease as your income decreases. Although your incomes change over your lifetime, your tax obligations change proportionally, so they remain relative to your ability to pay. The tax consequences of such changes should be anticipated and considered as you evaluate choices for financial strategies. The tax code does change, but you can usually be aware of any tax code changes far enough in advance to incorporate them into your planning. That concludes this presentation. I hope you enjoy reading the chapter.